If you think this war is about oil, you're already behind, because wars don't just move armies, they quietly shift power. And right now, that shift is already happening. On the surface, you see conflict, headlines, tension, but underneath, something much bigger is being tested. Not just resources, not just territory, but control over how the world trades and what everything is priced in. If you're starting to connect these dots, you're already ahead of most people. So stay with this, because what we're about to break down is something most people won't see until it's too late. Most people assume that conflicts in the Middle East are primarily about oil because that's the most visible and easily understood resource. But the deeper reality is that oil has historically been tied to something far more powerful, the global financial system built around currency dominance. For decades, energy markets have been priced and traded largely in one currency, which created a consistent global demand for that currency, regardless of where the oil was produced or consumed. This system didn't just benefit trade efficiency, it reinforced financial influence, allowing one economy to extend its reach far beyond its borders through liquidity, debt markets, and settlement systems. When oil flows through a single pricing mechanism, it indirectly strengthens the institutions behind that currency, from banking to global reserves. What makes current geopolitical tension significant is not just the disruption risk to supply chains, but the growing willingness of certain nations to explore alternative settlement methods, bypassing traditional structures that once seemed unshakable. These changes don't happen overnight, and they rarely make headlines in their early stages, but they represent a gradual shift in how economic power is distributed. When countries begin experimenting with pricing energy in different currencies or creating parallel systems for trade, it introduces fragmentation into what was once a unified framework. That fragmentation reduces the automatic demand that previously supported the dominant currency, subtly weakening its position over time. This is why focusing only on oil misses the bigger picture, because the real transformation is happening in the financial architecture behind it, where influence is determined not just by resources, but by the systems that control how those resources are valued and exchanged. For decades, global oil trade has operated within a framework where transactions are predominantly priced and settled in a single currency, creating a powerful feedback loop that reinforces its global dominance. When countries import oil, they need access to that currency, which drives consistent international demand regardless of their own domestic economic conditions. This demand supports deep and liquid financial markets, allowing the issuing country to borrow more easily, finance deficits, and maintain a level of economic flexibility that others cannot replicate. It also strengthens global banking networks, as most cross-border transactions, settlements, and reserves are tied back to this system. What makes this structure so influential is that it extends beyond energy. Once a currency becomes embedded in something as essential as oil, it naturally becomes the default for trade in other sectors as well. However, this dependence also creates a point of vulnerability. As geopolitical tensions rise and countries seek to reduce reliance on a single financial system, there is increasing interest in conducting energy transactions using alternative currencies or bilateral agreements. These shifts may seem small in isolation, but collectively they begin to chip away at the uniformity that once defined global trade. When even a portion of oil transactions move outside the traditional system, it reduces automatic demand and introduces variability into a structure that relied on consistency. Over time, this can lead to a more fragmented global market where multiple currencies compete for influence rather than one dominating by default, gradually reshaping the financial balance that has been in place for decades. Geopolitical conflicts have a unique ability to accelerate changes that would otherwise take years or even decades to unfold, because they force countries to make decisions under pressure rather than preference. In stable environments, nations tend to follow established systems simply because they are efficient and widely accepted, even if alternatives exist. But when conflict introduces uncertainty, whether through sanctions, trade restrictions, or security risks, those same countries begin to reassess their dependencies. What once felt reliable can suddenly appear vulnerable, especially if access to key financial systems or currencies can be influenced by political decisions. This creates a strong incentive to diversify, not necessarily out of ambition, but out of necessity. As a result, governments and institutions start exploring alternative trade routes, payment systems, and currency arrangements that reduce reliance on any single point of control. These adjustments are often quiet and gradual, taking place through bilateral agreements, regional partnerships, or new financial infrastructures designed to operate alongside existing ones. Over time, these parallel systems gain traction, particularly if they prove resilient during periods of instability. The longer a conflict persists, the more time there is for these alternatives to mature and become viable at scale. This is how geopolitical tension transforms into economic evolution, not through a single dramatic shift, but through a series of calculated adaptations. Each adjustment may seem minor on its own, but collectively they can alter long-standing dynamics, gradually redistributing influence across multiple players instead of concentrating it within a single dominant framework. In recent years, there has been a noticeable shift in how some countries approach international trade, particularly in their willingness to experiment with alternatives to traditional currency systems. Instead of relying entirely on a single dominant currency for cross-border transactions, certain nations have begun forming bilateral agreements where trade is settled in local currencies or through currency swaps. This reduces their exposure to external financial pressures and allows them to maintain greater control over their own economic activity. One of the key drivers behind this trend is the desire to minimize dependency on systems that can be influenced by geopolitical decisions, especially during times of tension or sanctions. As a result, new financial pathways are being developed quietly, often outside the spotlight, where trade flows are redirected through alternative channels. These changes are not about replacing the existing system overnight, but about building optionality. When countries start to price commodities, including energy and currencies other than the traditional one, even in small volumes, it introduces diversity into what was once a highly uniform structure. Over time, this diversity can expand as trust builds within these new arrangements. The process is gradual because large-scale systems require stability and confidence to function effectively, but once a foundation is established, growth can accelerate. What makes this development significant is not the immediate scale, but the direction it represents, where the global financial landscape becomes less centralized and more distributed across multiple participants and systems. The true strength of any global currency is not just rooted in economic size or military power, but in the level of trust it commands across borders, institutions, and generations of decision makers. Trust is what allows central banks to hold reserves in that currency, what encourages businesses to price contracts in it, and what gives investors confidence to store wealth within its system. It is built over decades through consistency, rule of law, deep financial markets, and the perception that the system will remain stable even during times of crisis. This kind of trust creates a powerful network effect where the more widely a currency is used, the more useful and necessary it becomes, reinforcing its dominance without needing constant intervention. However, trust is not static. It can be influenced by changing geopolitical dynamics, policy decisions, and global perceptions of fairness and stability. When countries begin to question whether access to financial systems could be restricted or influenced by political agendas, even indirectly, it introduces uncertainty into that trust. This doesn't immediately cause a breakdown, but it does encourage diversification as nations seek to reduce reliance on any single system. Over time, even small shifts in behavior, such as holding slightly less in reserves or conducting trade in alternative currencies, can signal a gradual change in confidence. As trust becomes more distributed rather than concentrated, the system evolves from one built on near universal reliance to one characterized by multiple options, each competing for credibility and influence. Financial systems are rarely reshaped by the direct impact of war itself. Instead, they evolve through the secondary effects that conflict creates across markets, policies, and behavior. When a conflict begins, the immediate focus is often on physical consequences such as disrupted supply chains, energy volatility, or regional instability. But the deeper transformation happens in how governments, institutions, and investors respond to that uncertainty. Sanctions, trade restrictions, and shifts in diplomatic relationships can alter the flow of capital and limit access to established financial networks, forcing affected parties to adapt in ways that gradually reshape the system. These adaptations might include creating alternative payment mechanisms, strengthening regional alliances, or restructuring trade agreements to reduce exposure to external pressures. Over time, these changes accumulate, forming new pathways that operate alongside or partially independent of existing frameworks. The process is subtle because no single decision appears large enough to redefine the system, but collectively they introduce a different structure of interaction. Markets respond by repricing risk, banks adjust lending practices, and investors reconsider how they allocate capital across regions and currencies. This chain reaction spreads far beyond the initial conflict zone, influencing global financial behavior in ways that are not immediately visible. As these indirect effects continue, they begin to alter long-standing relationships between economies, gradually shifting influence away from centralized systems toward a more distributed and complex network of financial interactions. Major economic transformations rarely happen through sudden collapse. They unfold as gradual shifts that build momentum over time, often going unnoticed until the change becomes undeniable. Systems that appear stable on the surface can be undergoing quiet adjustments beneath, driven by small but consistent changes in behavior, policy, and incentives. In the context of global finance, this means that instead of a dramatic event where a dominant system fails overnight, what typically occurs is a slow redistribution of activity. Countries begin diversifying reserves, businesses explore alternative trade settlements, and financial institutions adapt to new forms of risk. Each of these actions may seem insignificant on its own, but together they create a directional change. The reason this process is so difficult to detect early is because the existing system continues to function, giving the impression that nothing has changed. Transactions still clear, markets still operate, and liquidity remains available, which reinforces the belief that stability is intact. However, the underlying dynamics are evolving, and the relative importance of different components begins to shift. Over time, this leads to a tipping point where the cumulative effect of these small changes becomes visible in measurable ways, such as reduced dominance in trade settlement or increased competition from alternative systems. By the time this shift is widely recognized, much of the transition has already taken place, making it difficult for those who relied on the old structure to adjust quickly enough to the new reality. The impact of large economic and financial shifts rarely reaches individuals at the same time it begins at the global level, because there is always a delay between structural change and personal experience. At the top, governments, central banks, and large institutions react early, adjusting policies, reserves, and strategies as soon as they detect emerging risks or opportunities. These decisions then influence corporations, which respond by modifying supply chains, pricing models, and investment plans. Only after these layers adjust does the effect begin to filter down into the daily lives of individuals. By the time it reaches households, it no longer appears as a systemic shift, but as a series of isolated pressures such as higher prices, changing job conditions, or reduced purchasing power. This delay creates a false sense of security because people tend to rely on their immediate environment to judge economic health. If their job feels stable and their routine remains unchanged, they assume the broader system is also stable. However, by the time visible changes occur at the consumer level, the underlying adjustments have already been in motion for a significant period. This is why individuals are often the last to react and the most exposed when conditions tighten. Without early awareness, they are forced to make decisions under pressure rather than from a position of preparation, which limits their ability to adapt effectively and increases the likelihood of being negatively impacted by changes that could have been anticipated earlier. When you step back and look at everything together, the real message becomes clear. This isn't about a single conflict, a single country, or even a single market. It's about a system that has been stable for decades, slowly entering a phase of change. Not collapse, not chaos, but transition. And transitions are always uncomfortable because they don't announce themselves clearly. They unfold quietly through shifts in behavior, adjustments in policy, and small decisions that compound over time. What once felt permanent begins to evolve, and what once worked without question requires deeper thinking. The mistake most people make in moments like this is waiting for certainty. They look for a clear signal, a headline, or a breaking point that tells them something has changed. But by the time that signal becomes obvious, the shift is already well underway. The advantage has already moved to those who were paying attention earlier. That's why awareness matters more than prediction. You don't need to know exactly how events will unfold, but you do need to recognize when the environment is no longer the same as it was before. The real takeaway is not fear, but responsibility. Responsibility to question assumptions, to stay informed, and to think beyond short-term comfort. Because in a world where systems evolve, The people who adapt early are not the ones who panic. They are the ones who position themselves differently. And in the end, it's not the change itself that determines the outcome. It's how prepared you are when that change finally becomes impossible to ignore.